how to build the trust for the financial institutions, because we see emergent markets between crypto and stable coins with the fiat. Maybe I would like to start with a little bit introduction for yourself, Lex. Like, what is your experience and what the company is doing?
I co-founded Global Ledger back in 2019. What we do is we de-anonymize wallets on the blockchain. So you probably heard that Bitcoin is anonymous and all other cryptos are anonymous. Well, in our case, that's sort of debatable. And probably the better term is pseudonymous. We know just for Bitcoin, we know maybe about 400 million wallets who owns them. And this might include not only like deposit wallets of users at crypto exchanges, but also darknet, ransomware, hacker wallets, and things like that. And we provide that data as a service and reports based on that data for governments. We provide investigation tools and software for law enforcement to trace and block stolen funds. And we also provide that for banks, crypto exchanges, OTC desks, on-ramp, off-ramp payment systems, for them basically to fulfill the regulations and compliance obligations and stop fraud, money laundering, and just obey the regulations and keep their license as the law requires. We do that specifically, like the whole product and the whole system is created to be the fastest because we believe that, money laundering is very fast in crypto. Like you probably need like a couple transactions, a couple minutes, and many systems that are on the market, they are slow, and expensive. So we're trying to kind of solve that slow and expensive problem by cutting costs and increasing speed.
That definitely makes sense, because I see personally the trend in payments rails that everything should become real time, and with the real time, it brings a lot of questions. How will we do properly check and ensure that there is no frauds and anti-money laundering activities, which is once again pretty connected to the blockchain and stablecoins. But I would like maybe to go with the angle, like, what is your overview on the market shifting from 2019? You founded the company, and what is your feel of the current state? Is it growing? Is it becoming the standard right now for the financial institution to use your services, and as a next step to use stable coins and the crypto in their fiat businesses?
There's more and more financial institutions entering crypto sphere, more as we can say, like TradFi, traditional financial institutions like banks, hedge funds, investment funds, private equity firms, OTC desks that would work on traditional sort of stock exchange markets, starting also work with crypto. We can see crypto ETFs and things like that. Compared to 2019, and this is what allowed these institutions to come in, the regulations are much stricter but also clearer now. Like back in 2019, it would be like a tourniquet in metro in Kiev. Like you might pay for the license, but you wouldn't know, like the doors are open, but you wouldn't know like if they will shut when you're just in the middle of it, like these gates. So now it's much more like a sort of European style gates where you get a license and the door opens and then you work sort of freely. So this shift in like the way you enter the market, the way you can offer that service, allow these institutions to be sort of more certain when they enter them.
That's definitely a takeaway that I would like to highlight, because it's not even the question about the regulation, how strict they are, but how easily you can read and follow and understand what is expected. Definitely, we had clients who were trying to do the blockchain as a technology and maybe even some crypto back like 5-10 years ago. But I think the difference is that right now it's much more clear what the regulation is expecting you for doing and what are the punishments. Because even if you do certain things, you're taking the risk. It wasn't clear what are the consequences the regulator will bring on you. And right now, I think we see that the adoption on tier 1, tier 2 banks allows them to say, okay, the legal departments, they sleep in well, they understand the consequences, and they can run the business without having this pressure, like how regulator will take a look on that, but will have any consequences for that. That's really good.
I can summarize you what is the regulation, because I was thinking like what's the good analogy to actually like explain people like how to deal with regulators and how to deal with regulation. And we found one analogy in the conversation with one of the clients. So imagine you are this hero of like a knight, that is standing in front of the valley of death, and in this valley of death. Like if you imagine there's a valley here, right? And as soon as you sort of take off as a business, as soon as you get traction, you get users and things like that, you would immediately attract what I call liquidity parasites, like which are the fraudsters, like people with dirty funds, hacked, stolen, whatever, corruption or something. So you would immediately attract them as soon as you have liquidity, right? So these are the first sort of, I don't know,
Customer adopters.
type of evil actors you would attract, right? And the second one that would be immediately attracted as well is the regulators. And what's interesting, like most of the businesses, most of the knights, they would think about them as this big three-head dragons. When one head is financial intelligence unit, the biggest head is like national bank, and somewhere there is I don't know, like a securities commission or any other regulator that would regulate commodities in your country and things like that. So, and people fight both. They fight the parasites and they also fight the dragon.
Yeah.
But what you need to do, to cross that valley and get to the chest of like extreme adoption and exponential growth, you need to get the parasites and feed the dragon.
Oh, nice. That's a really good analogy.
So that's what you need to do. You just need to spot the parasites and you need to give them to the dragon. The dragon will do all the things and the dragon will be happy. It will allow you to pass. You guys will be best friends, and he will help you to open the chest and fairy tale and butterflies and beer after 7 p.m. Like it's gonna be nice. So, and this is what our product also do. Like it can help you spot the parasites and then report the parasites. That's basically what the regulators and regulations require you if you summarize down to the like very very essence.
It sounds like a book title: "How to Stop Worrying About the Dragon and Love It." So that's definitely it.
Yeah, you just feed bad guys, and the thing is, parasites don't care about you. What they want is they want to use you in an abusive way, right? So they want to give you dirty money. They want to get the clean money of you or your customers. They create problems for you. They attract the regulators on you. So they don't care really. They are not your best users. They might bring some money short term, but long term they will just switch to another guy like you after you have problems with license and things like that. So they don't care. They are bad actors. Their money are worth reporting.
How big this market is, because like we have the numbers and official statistics for whatever is happening in fintech as acquisitions, rounds, etc., but there is no stats, I don't know, maybe for me publicly, that you can go and say, okay, actually there are top 2-3 tiers who are helping to launder the money in the, I don't know, acquisition or whatever is happening on their side. So is there any numbers how big the black market and gray market for money laundering and utilizing and leveraging those institutions who are providing their financial services?
Well, it's an interesting question for us to research. We definitely have the data to answer that question. But I think as of now, no one did any sort of research specifically like that. I can tell you some anchors, that would give you some sort of understanding. So if you think about things like, very bad things like terrorist financing, sanctions, darknet, drugs trade, weapon trade, child abuse materials, which is a very dark thing that people pay in crypto still. All sorts of these things. On average, every crypto exchange would have like sub 1% exposure to that. So if you think about like a volume of a crypto exchange would be like, I don't know, $500 million, then 1% of it could be dedicated to these categories on average. We're actually going to release a report that would give you like the exact number. Among all of the transactions in crypto in general, because some of these entities, they exchange money between themselves, not even going like a licensed entity, exchanging on a very licensed exchange, like Coinbase, for example. In general, in crypto, it's about, it's a bit below like 2% of all transactions. And this is a good and bad at the same time. So it's good because in percentage points, it is way down from like 30% of all transactions back in like 2014, 2015. So in 2014, 2015, this is where you remember that all the news outlets were saying like Bitcoin is drug dealers' money, because it was. It's and historically we can look it up. We can see all these darknet marketplaces. Silk Road was particularly big at that point, and Bitcoin was attracting the parasites at that point, in a sense. And now with all the regulations, licenses, compliance departments in many exchanges, the collective achievement of the industry is that it is sub 2%. Some of the things that are like when you tell to a TradFi person like a TradFi compliance officer or regulator, they might seem outrageous because let's say we know that North Korean hackers, and this is not me telling you, like there was a UN report compiled of different companies' contributions. North Korean hackers using stolen Bitcoin that they steal with government-backed hackers from crypto exchanges, in particularly in South Korea, they use it to fund their nuclear program. And it is all in the plain sight. So we can see those Bitcoin movements. We know how much there was Bitcoin they stole and how much they laundered, even how they laundered that. But we can do nothing to stop this, which is something like in the banking system, you either don't know, either you stop, in most cases. I mean, there are some jurisdictions and something, but in most cases, it's more stoppable than crypto. Yeah. So people can do very nasty things, be in the plain sight, and still be able to pull it off. Like it's pretty crazy. But it's improving. I mean, if you think about 30% down to 2%, it's good. The bad thing about that is that in terms of number of people involved and volume in terms of dollars and euros, these amounts are like more than tenfold from 20, 2015, 2016. Yeah. So it's even darknet marketplaces, drug trade. I mean, for example, there was a market. It's pretty like a, I don't know, like a biblical type of story. There was a darknet marketplace called Hydra. It was shut down by authorities, and it's like like in ancient Greece. I don't know, like there's 3 new marketplaces, the copycats almost immediately created, and they all now the size of the original one. So it's about like 6 million wallets, more or less, for each marketplace. Some of them have way more. So that's pretty big numbers, and this is very fast growth, given the fact that it's 3 years only it took them to get the amount of wallets. By amount of money, the gray and dark industry is actually growing. So, and the sad thing is, if you think about where people pay in Bitcoin, you probably haven't paid for anything. Like I once paid in Tokyo, I paid for shawarma in Bitcoin. That was true. Like the level of adoption I was surprised. And I paid for Japanese karaoke in Bitcoin, which was crazy. Yeah, there was sort of like the many crypto offices in that part of the town. But other than that, like people don't pay a lot with Bitcoin, except for 2 industries. Like the top one would be iGaming. I mean, your crypto casinos and many traditional casinos actually going crypto now. In particular, because it is way easier to work with large accounts, like VIPs, a person that want to spend, I know a person from Brazil that want to spend 100,000 or a couple million in a casino that is in different part of the world. The crypto is the obvious choice here. And so the iGaming would be number 1 by actual payments where people spend money, and darknet will be number 2. So in that sense, the peer-to-peer money type of notion we all know about Bitcoin doesn't work after 15 years, or work only in a limited number of cases, really.
Maybe the takeaway that I would like once again to highlight, that there is no kill switch for the transfers in blockchain. So that's the difference. When we're talking about the national rails, banking rails, there is an operator who is under regulations and heavily oversight from all the authorities. And technically, there is a kill switch, which can be executed for a specific company, and I assume on the specific transactions, because the institution themselves, they obliged to do the check-in, they having those pending transactions, and in the end of the day, they deciding if it's going to be settled or not. With the blockchain, if you have the funds, there is no kill switch. That is design of the system.
Not every time. That's what I can say. Like in case of stablecoins, in most cases, there is a kill switch. Yeah, and this is good because that's how you can return stolen stablecoins. But in case of Bitcoin, Ethereum, and many of these things, yeah, there's no kill switch.
So in this case, it's like the design of the system, because if you are doing the design of the house, depending how good and how smart with the planning and spacing you are, the better solution you will get. And I think something similar is here. That's why even personally, I really distinguish the stable coins and the blockchains, because blockchains, they're different by nature and by architecture, and stablecoin is some kind of marriage between fiat and non-fiat world. So we have certain advantages, we have certain disadvantages. That's really good one. I really would like to go back to the North Korean guys, but we will do about it later, because I've prepared myself for the episode, and I was thinking like there is a really big hacking which has happened like last 2 years, and it almost was up to $2 billion. I think the biggest hack that has been seen so far. But let's keep it to the end of the episode. And I see that you have an ability to really express how the things are working with the good analogies. So, what is your message to the businesses out there who are licensed and they are fiat? What they should keep in mind while they're architecturing their software and their product for use the stablecoins and maybe even potentially the blockchain, because it becomes more standard nowadays.
You need to understand where the strengths of stablecoins are. And in terms of your local payments, I mean, if you have connection to a card and these kind of things, that sort of improves UI for the customer. But in general, for many customers, if they are not crypto holders or not earning in crypto, that might not be a compelling point to move to stablecoins for some reason. It's like for them, it's another step to buy these stablecoins. Using their credit card. For them spending that, I know, minus 1% for payments. So if it's like non-crypto people, it will be very hard for you to convert them into crypto people with these sort of offers and the UX that we have right now. However, if we think about things like international trade, there is no way any local currency can compete with stablecoins. Even if people will launch CBDCs, maybe some sort of like international CBDCs, but these are far off. Like there are no viable projects that would launch tomorrow. Like one of the cool projects I think is launching now in United Arab Emirates under the ADI Foundation. So they launch a crypto dirham that will be used for international trade, which is pretty cool because dirham is also sort of pegged to dollar. So you have almost like a USDT for Middle East for international trade. That's great. But in general, like the stable coins for international trade are inherently superior because they don't have that sort of border control for money. So your money, you created stable coins in Vietnam, you can immediately send them to Brazil and they will arrive immediately to Brazil. You can fly with them in the airplane, you can send them seamlessly for close to no commission. The same transaction, if you want to buy a tanker of stuff with that sort of distance and difference in money, in local currencies would take you like 2 weeks, very painful compliance wise, and will be very painful commission wise. Exchange a national currency to stablecoins, make an international transfer in stablecoins, and then exchanging it back will create enormous opportunities. And this is what we see. This is why I'm bringing up that case, because this is where we see a very good use case growing on chain. Like people buy ships of stuff now with stablecoins internationally. They sell it then for national currency, and they don't do like e-commerce and crypto a lot, but they buy stuff in bulk with stablecoins. Another thing is, if you think about stablecoins, the very important point is to choose the right stablecoins to work with, like that will reduce your risk and will not create you also compliance troubles if you exchange international currencies. Like in this case, it's very interesting. Like what fascinates me about stablecoins and especially Tether, I think Tether is actually a very important company for the industry, and historically they were very important for the Bitcoin takeoff as a mainstream thing. They literally created the arbitrage, and there are many achievements they did. But if I call any of my very, very professional friends, and it will not be April Fools, and I'll just tell them, look, Tether is going to zero tomorrow, half of them will believe me because they still have no sufficient evidence over where collateral is. Is it really one-to-one? Can we trust it? Like, where's the proof? And half of them will really believe me, and they will be like, oh my gosh, my money is done. So they will still have Tether, they will hold it, they will transact it, but they sort of accept that risk, which is crazy if you think about like they might not accept the risk of their national currency, which might lose some value over time, but not going to zero. They would accept risk going to zero, but still transacting with Tether because of a few very good use cases they have that the national currency or a volatile crypto just cannot provide them.
In this case, there is an element of the inertia. Like if you used to do something, even if the things are getting worse, you still accept it because that's the way how you learn to do it, and that's the way how you accept it to do it. So maybe that's an element there. But in terms of building trust, because you tackled a really interesting topic like a trust, and I see that people trust Tether despite of even some evidences or some questions that out there, like how they bake in one-to-one, where they doing all those things. So how do you think in terms of from the business perspective, international trading is good. That's a really good example. We have clients who are targeting the business for international trading, even the individuals, because there is a demand for that. The world become more closer, even despite all those challenges that are happening right now. But what is the angle? Because I think the services of your company is helping to build the trust, because we know what is happening. We have some control and understanding how to deal with the bad cases. But as a business, what I should put into the priorities, top priorities? Is it technology, investment in the security? Is it investment in the compliance? Is it into educating customers? Like what you would say from your experience, if I'm opening the business for international settlement and stable coins, what should I do?
I think it's a bit sort of messed up in many senses in crypto. A very simple answer would be in terms of trust, you shouldn't go too high or too low. You should be like right in the middle. This is where you get like your Binance, for example, as that sort of example. This is where you can grow big. Let me explain you why. Like if you think about trust, right? So in crypto, there was this notion that you have to be your own bank, which means like you have to hold your own crypto and trust only yourself. You don't trust anybody. But that didn't work. Like it's it's not decentralized. People are still using like no one is running Bitcoin node at their home. Like let's be honest. Like people use wallets, so they have to trust the wallet provider. People use exchanges to hold crypto, exchange crypto, and things like that, right? So DeFi volumes compared to those exchanges is tiny. So people like to put trust where they think professionals are working. Like they think, okay, these guys know what they're doing security wise. This exchange haven't been hacked for that amount of time. And if they got hacked like Binance and they've recovered, then that's even better. Like as funds as a fool.
Second time, the it doesn't strike the same place.
Yeah, something like that. So people actually what we realized like to be your own bank, you also need to be your own compliance department, your own security department, and people don't want that. They want to make quick transactions. They want convenience probably more than this trustless notion and things like that. And people, it's not like the whole thing is not decentralized as it was sort of not promised, but it was sort of expected to be decentralized. It is centralized. Like and it's centralized by trust. Like if people trust the platform or the platform has some conveniences or opportunities, people centralize on that. And the funny part is why I say is like you shouldn't be like too low or too high is that if you think about banks, like banks were accumulators of trust.
Exactly.
They are the pillars, the cornerstones, and they definitely have a ton of security people, a ton of compliance people. They would not have a situation where your CEO will be in jail tomorrow, like it was with FTX. They wouldn't be like doing accounting in QuickBooks or Excel. Like things should be fine there, right? So we could think like, okay, the bank was like the crypto exchange was here for 5 years. If bank would hire crypto people and the bank was here for 300 years, that should be better, right? No, wrong. So that didn't work. Like if you look at that, like there's no bank that would have a volume at least like to like a mediocre crypto exchange launched by a couple teenagers, a few years ago. Why is that? Because that level of trust to the bank is scary. So people scary that if there is ton of compliance people, I might have the same compliance questions and problems and slow transactions as I had in my bank before. Why would I put my crypto there? And it's sort of that sort of level of trust is so big and scary, so it kind of takes away people's sort of sense of freedom of their money. It's like so it's like thinking, okay, if I put it in a crypto exchange, it's like-minded people are doing this, and I can trust them because they are like-minded, in a sense. And it's like why people hate banks, because banks are slow. Why they're slow is because the compliance tools are slow. And this is getting back to the question that the compliance itself and given the speed as well, like of transactions in crypto, it has to be faster. And the banks, if they wanna, if you're a traditional financial institution entering crypto, you have to provide that like-mindedness in terms of how fast you do all these checks, how fast you can really approve your customers, and how good you are at rejecting false positives. So you don't create situations where a person with good legitimate money waits like 3 weeks until managers will pick up his file in the pile of files, and things like that. Yeah, you shouldn't go too low or too high.
It reminds me because I finished the information security, and one of the equation in information security that the security is equal to one divided by the usability, and that kind of actually answers the question because the banks are secured because they are not so useful or user experience is different. Like you might wait, you might have additional questions, you might be even rejected at the door at the branch for opening an account, which is totally different living in the digital world because we expect everything to be real time from the couch on our phones, and that potentially the gap which created this air gap, I would say, that created the ability to market, to evolve and provide those services. And what I'm thinking, like that's definitely true. So you should be good enough and fast enough for moving into the digital world, providing the services to the customers. But on the other hand, you should not be really shortcutting the things because other way you would be screwed from this real part of the world. Okay, that totally makes sense. And in terms of maybe the more and go a little bit more into details, like there is a process, and I would like to educate our listeners with the crypto, with the fiat world, we have IML sanction screening. Like when we start in the transaction, we're picking up who is going to receive the transaction. And that's quite clear because with the banking system, you have names. Basically, Igor opened an account and bank X, you're supporting this information. And then even the receiver bank technically can compare who is the receiver, who is the sender, and do on the both sides the processes for ML and compliance. But when we are talking about the blockchains, actually there is no receiver because the network is kind of anonymized. And you're definitely right with the pseudo anonymization. But when we're sending the money, we see the wallet from the, let's say, institution. So we send in, and then the sender is filling in additional information, which might not be true. Like, I don't know, take a look on any wallets. Whatever they asking, it gives the feeling that they asking because regulator pushed them to ask, but it's not really something that you cannot say. You can send the money to yourself, even sending to other people saying that it's my own funds, I'm sending to another wallet. So in terms of the KYT, know your travel or travel rules, what is the difference in your opinion? Like how to explain why we have to do that? And what is the difference between usual banking rails and fiat transactions?
In fiat, you basically have a transactions where one bank is sending money to another bank. And while this transaction is happening, the banks are exchanging information about who's the sender, who's the receiver, and all sorts of different things. So you don't really, so just because the transaction is not anonymous, you don't do a lot of checks. Like, because it is assumed that the previous bank already checked that these money, like let's say if you're sending from your wallet to your wallet, the next bank will not ask you for source of funds if it's especially like in the same country, because it is assumed that the previous bank already did all of that. Where in crypto, it is very different because the wallets are anonymous, as you say, and that could be a payment from someone. This wallet could be a part of the terrorist group. This wallet could be someone who received money from a ransomware attack, all sorts of different things. And you have to check for that because you, as a responsible entity, also probably don't want these sort of parasites, right, in your garden. What we as a company are doing, providing what information we can give the exchanges, the banks that are asking about that. The first thing is who owns the wallet. Many of these wallets are de-anonymized as they are. A lot of them, they have public mentions or, social networks, Telegram, many different things, many different sources. Mostly we store information and de-anonymize sort of companies, legal entities, and clusters of wallets, less focusing on individual, like physical people. And for any wallet, we can basically tell who owns the wallet, especially if it's an entity. Was there any events or hacks or forum posts or anything associated with that wallet? What other wallets this person could have? What's the location of that wallet? Where this person has accounts at exchanges or platforms or some sort of these things. And this creates a profile. So if in this profile you have accounts at licensed exchanges in good jurisdictions, you're all clear. Like our system will give you the risk score of, I don't know, 30 out of 100. This will not trigger any alerts for the compliance officers to make enhanced due diligence on you, except if your amounts are too high. But if you somehow received money from Iran or from Russia, you participated in some events or activities that could be considered a high risk by the regulatory guidelines, This is where the compliance officer will get alert and will investigate you, will ask you questions, and things like that. There's much more to that. It's more sort of deeper process. The thing is, by law, I cannot tell you all the details because this is considered tipping, which is, I think, in the notion where you have to be your own compliance is not very connecting to that. I don't know, but really cannot tell you more. So, but there's a lot of different bits of information the bank collects, and then they have a profile on you, and every bank has their own sort of risk appetite and risk analytics process, and based on that, you can be above or below certain thresholds, and there's certain thresholds when they will ask questions. There's some thresholds where they will directly send your profile to the regulator and see what's going to happen next.
So feeding the dragon. I think here is more interesting what the process means rather than how it's implemented. I'm more on the side that obscurity is not security. Like by not knowing how it's done, I think the people who are trying to avoid the screening and somehow leverage the KYT for using, I don't know, through different techniques, they will aware how it's potentially is built. They have money, resources, and willingness to explore those things. So I think for our listeners, it's not so important, but important takeaway that being in transactions with the crypto in even stablecoins will in different payment rails, which acts differently. And I would say by default, it might be even a little bit hostile because if you're receiving the funds, you cannot actually cancel the transaction. So if I have a wallet, someone dropping me from the source, which is not really good for the compliance reasons, actually I cannot cancel and say, yeah, I don't want this. I don't know this one. So that's another thing. Technically, it might be even with the bank, but then it's much more rules. So you can say, okay, I have nothing to do with that. You can talk with the legal departments of the banks, etc., etc. That's really insightful. I think it gives a lot of food thought for our listeners. But the last question that I would like to run through, and we are running out of the time, what makes the North Korea attacks unique? Because like at Lazarus Group, if I'm not mistaken, that's the name of this group, and they've been notoriously known for stealing large pile of money. And as you said, it's on the plain side. So anything that you think it's essential to share with our listeners about those attacks or this group?
In general, when hacking groups starting to having Jira and daily meetings, they become very effective. They gain experience, and you are the person that has no experience, and they try to hack many people already. The one of the most common tricks they use is they get hired in a company. So they might use AI or fake identities to actually get a remote job. And this is what happened in many of the hacks under the Lazarus group. And with this, they will analyze the code and they will try to get more up the food chain of the development hierarchy and embed a piece of code that would allow them to receive approval where they shouldn't, or create a vulnerability or deploy a smart contract that is not meant to be deployed, and combined with other methodologies they have, which are they do have an arsenal of a very professional hacker group. And what is interesting is that they are not only excelling in how they hack. And, when you get hired and you have access to the code, it's not like you should have a huge talent, right, to do something about it. But it's how they launder money after, because this operation is also extremely professional, very fast. They use a lot of fake identities, passports bought on the dark net, money mules. They fund their covert operations with that in many countries. They fund their own internal nuclear program with that. And this is interesting because even the most professional three-letter agencies we know in the world from US and Europe cannot stop that happening, even with the most sophisticated tracing tools and stuff like that, which is a very interesting game of shield and sword. It's not a lot of money that was recovered after the North Korean attacks. Interestingly, ChatGPT and neural networks that are trained now on databases like Metasploit, where all the vulnerabilities are listed, allow any hackers to really get into the game, not even North Korean ones. So North Korean is just like a top dog. I mean, probably if you get hacked by North Koreans, you have a very cool story to tell till the end of your life, right? But what we saw in recent days is that the rise of hacks based on LLMs. So LLMs are analyzing the victim machine or the smart contract. In many cases, it's a smart contract. LLMs are writing the exploits. And yeah, this creates a totally new frontier for all these hackers to like script kiddies now are very powerful, in a sense.
Actually, it reminds me the story about hacking first iPhones, like jailbreaking. And the breakthrough by Gerhard, if I'm not mistaken, was done because they basically wrote the tool to test the protocol for updating the iPhone. So there is a payload which is encrypted, but the guys, what they did, they wrote the testing or acceptance application, which were testing different values and overflow buffers, whatever, to exploit the application which is uploaded into the firmware. And they succeeded. So having the tools which optimizing and scaling your operations is essential. And it seems that LLM working this way in a not good way, but still helps people to scale the operations, which might be the case that good guys can use LLMs for scaling their checks and their code quality in the same way. So that's really good.